Good afternoon, everyone. BD from Bluestone Flagship Investor. We're here today with a very awesome guest, Kelly Winget, who's not only just is a passive investor in the alternative space, but she's really expert in this domain. I did have a chance to run to her in one of the podcast interview, and I invited her to actually join us today. So please welcome Kelly.
Hi,
Hey,
thanks for
Kelly.
having.
Wonderful. Please give us a little background about yourself for a lot of the audience.
So I've been in the alternative space, exclusively in private investing for almost 15 years. I got started in oil and gas. I'm five generations in oil and gas, so I was going to end up there one way or another, anyways. And for the last 10 years or so, I've been kind of going back and forth between helping emerging companies raise capital to investor education, ultimately ending up in family offices. So I worked with a couple different family offices before I branched out on my own in the middle of the pandemic in 2020 to start Alternative Wealth Partners to invest in the alternative space, provide a lot more transparency and access to the alternative space, as it's a pretty highly gate kept investment strategy. And so we're on our third fund and investing pretty heavily into the alt space. And that's everything from oil and gas working interests to tech startups.
Awesome. Well, let me maybe unpack that a little bit for a lot of our audience. So one of the things you mentioned is oil and gas, and that's something that we constantly look at as far as being invested in oil and gas. Another thing was the family office. Maybe a lot of the audience might not know exactly what family office.
Mhm.
Before we get into the partners, the wealth partners. So maybe
Sure.
could you mind maybe doing a little more elaboration on oil and gas investing and your experience in that space? And maybe a little bit more about what his family offices are.
Sure. So I grew up in an affluent home. So I was always around money. Money was not a taboo topic in my home. I had two parents that were accountants, CPAs. My father was a senior tax partner at Price Waterhouse for 20 years. So, like, these were all things that I had a lot of exposure to. Family offices are typically multi generational wealth families. So they have net worths north of $300 million. They have a staff of people that their entire job is to work on your money. Um, and most people don't have that kind of resource capital wise to have full-time attorneys, CPAs, tax strategists, financial advisors, wealth advisors. That's pretty exclusive to the family office space. And what I realize is that, like, if you don't know how to do all of these things yourself, like, you're going to be left out of the conversation a lot of investment opportunities that are specifically built for family offices. So I had a lot of exposure over my entire life that I wanted to then kind of crack open and give to other people, because you can scale down that experience. You don't have to have, a staff of people managing your wealth. You just have to take a lot of personal responsibility on making those decisions and putting in the effort to start making investments the same way.
Yeah. No, that totally makes sense. And I know family office, 300 million, you said, and above worth of net worth, it does require specialized people to really handle that. But a lot of us that are under 300 million,
Mhm.
it's almost like we have to kind of do it our own or
Yeah.
find a network of people to kind of work with to at least guide us in the right direction. It doesn't have to be professional advice, but more like, hey, what are some of the options that are available? What are some of the pros and cons? And I think that's really where a lot of people get stuck, because if everybody have the same information, it's easy to do decision making. But
Yes.
in many cases, not everybody has the same information, and then they might get one level of information based on the return of an investment, but not necessarily how tax efficient of an investment it is, or how is it going to impact their taxes.
Right.
And then you have to go step back and speak to their CPA or the tax. So it's really complex topic actually, and I think it's really tremendous value for people to be able to understand it or work with experts to kind of help them guide around that. So maybe could you touch a little bit more about what do you do in that space in terms of guiding? And I believe that's alternative wealth partners in some
Correct.
sense.
Yes. So alternative wealth partners, started out as a family office concept, and then it's like shifted into private equity We kind of teeter along the line of like traditional wealth management and what we believe the future of wealth management is going to be as more people want to branch outside of your traditional assets, which are like stocks, bonds, and cash, right? Everything else is considered an alternative investment. The problem is that a lot of advisors don't have the experience or education to actually advise on alternatives. They have no industry experience, they have no operational experience. So how are they able to actually give that advice to investors? And investors have to have the decision of like, do I stay a passive or active investor? And for most people, they're running businesses or maybe they're an executive at some corporation. Like they don't have the time, experience, or really desire to actively manage their investment portfolio, which is where active fund managers or asset managers come into play. And those are people that are actively investing on your behalf into things that you want exposure to. And in my case, that's the alternative space. So we're invested in things, energy infrastructure, manufacturing, private equity, private credit. These are things that aren't offered in traditional wealth management, not from your advisor. You can't go onto your brokerage account and buy XYZ alternative investment. You have to like go out and source deals, and you can't, if you're not going to do that personally, then you have to partner with active management to do that. um, there's a lot of different opportunities that investors can get involved in. Like I said, I started in oil and gas. That's how I got into this space, and I've worked on everything from oil and gas to real estate syndications to tech startups to operating businesses. So we've had a lot of different kind of exposure to different deals over the last, almost 15 years. And we get to bring that experience in for the investors now moving forward.
Well, that's wonderful. So much so much value to unpack here, and so much knowledge. So I'm just going to take one at a time, and hopefully dive into further. We definitely love the reasons how Alternative Wealth Partners kind of stands behind, which is really to enable the average, I'm not going to call the average Joe, but let's just say the accredited investors that don't have the know-how to invest into alternatives, succeed and get decent returns in investing in alternative. And the reason a lot of people are looking to shift out because just the 60-40 is not working anymore, right? The 60 more in 60% in stocks, 40% in bonds is just simply what a lot of the financial planners are doing, mainly because they don't have a whole lot more knowledge into the alternative space. They might know what it is, but they typically don't have the comfort zone to say, oh, get into this private deal or buy into this roll-up strategy or
Yes.
invest in an oil and gas. And it does require significant amount of work and knowledge in that space to be able to kind of bring that and recommend it to their clients. So they typically stay away, they kind of caution away from that. From your experience, I mean, when we kicked off Bluestone Flagship Investor, that was really kind of the main premise. I've worked myself in tech for 24 years, and I was just fortunate to be an accidental landlord, and we got to realize over time the benefit of real estate. And then I said, you know what, I want to double down. And I know very little about private equity. I've invested in angel startups and so forth, but didn't really know a whole lot about the elaborate space of alternative,
Mhm.
investing. And then just scaled up more, built up more of my knowledge into the from residential real estate to commercial real estate and looking at alternative things and kind of started opening it up for other, a lot of my colleagues to come in and say, hey, let's join forces and invest as a group. But again, we kept it more in the areas we understand more, which is around real estate. But now it's like there's a lot more than the real estate. And that's really kind of where we seek out industry experts outside just real estate, in the alternative space to talk to them and understand, hey, what else is out there? How should we really look at these investments? How do these investments affect our returns, our after-tax return? Is it better to invest on it from your retirement plans, or is it better to invest on it from our cash?
Yes.
So much of that gets into the unknown certainty, and then that's really kind of where I see value in meeting and having people like you that are entrenched in the alternative space investing, and it almost becomes like a miniature family office,
Yeah.
of some
That's
sort.
exactly what
You
it is.
know, yeah, individually, maybe each one of us is not enough to, have enough wealth to be a family office, but maybe collectively as a group, we can get there. So, how do we dive into more of that space? I think a lot of people in our audience are, I would say, more familiar in commercial real estate. So we're going to park that on the side right now and maybe
Okay.
dive into other interesting areas, whether it's oil and gas or whether PE, and just kind of, share with us a little bit more about the experience that you've had in that space, and what are some of the things that you would look for, when you're looking at private equity type investing, whether it's lending, private lending, et cetera, and so forth.
Sure. So a lot of people's like next step, so they have their stock portfolio, they have their bonds portfolio, they've got savings, is real estate. Most people's net worth sits in real estate, which is fine, but if that's all of your net worth is sitting in some type of real estate, then you're exposed to, again, one type of market risk, real estate going up or down, right? There needs to be a moment where I'm assuming you guys are at, where you're wanting to see what else is out there. And the thing that's important to remember about real estate is that real estate is only valuable when things around it start to be created, right? The businesses that operate inside of your commercial space, is there opportunity for higher rents? Like, are there job opportunities in your community? Like, the things that are going on in the actual physical space is where all the value is being created. They're paying you rent at the end of the day, but what's the upside of their business being in your space? And that's really what we think about when we are invested in real estate. It's typically as like an afterthought of the business we invested in. Like, the real estate is a nice security to have when we're invested in the equity of a business. It's the assets the business owns. But, at the end of the day, we're hoping that that business 3, 5, 10X's our return. And if it just happens to fail, we have a safety net of the real estate, right? The way that we structure our funds is like balancing a foundation of these tangible assets, these real assets, with things that are more moonshotty. So your private equity and your venture strategy. So within all of that, there's a different sets of tax mitigation things. When we think about how we're investing, like, your tax strategy is very important. Because at the end of the day, that after tax return is what you're taking home. So we're trying to get that tax advantage with the cash coming into the investment and with the cash coming out of the investment. If you can get really smart around your tax strategy, no matter what kind of asset you're investing in, you have a built-in 30% return. So the thing that people, especially investors who are trying to break out of just your traditional assets, need to think about is taxes are paid to the government to build things, right? The government spends that money on different things, and whether you agree with what they're spending on is your own prerogative. But if you can directly invest in the things that tax dollars pay for, you get the tax advantage, right? This comes from real estate, this comes from oil and gas, this comes from R&D, this comes from manufacturing, all these things that are typically subsidized by the government. You can invest in as a private investor and take the tax incentive and apply it directly to your own personal tax situation. So that's how we like to look at different things that we're invested in. What's the tax incentive inside and outside of the investment, and how can we use that to boost our entire return in our portfolio?
Wow. That's definitely value. So you almost approach your investment first from the company side, so the private equity side of things. And then you're like, hey, what if we add on the real estate option to really get a further expansion on the tax benefit of the profit of the business?
Yes,
Um,
I'll give you an example of this. So one of our investments is inside of a coffee farm, and we're invested in the equity of the coffee business. However, the entire investment is secured by the land that the coffee company owns. So instead of just investing in the equity and hoping that, the company grows and there's some sort of exit and we get our equity exit, we have like a fail safe built in. So we've mortgaged 1,300 acres of farmland in addition to the equity holdings we have in the company, so that, worst case scenario, maybe it doesn't work out, we still own 1,300 acres of farmland, which we can then turn around and sell. Um, I try to structure a lot of my deals in that way so that there is some sort of risk mitigation piece when we're invested in the equity. Not all of our equity investments are structured that way, but we do try to build in some sort of safety net.
Yeah, no, absolutely. I mean, that's quite valuable to be able to bound the risk or limit the risk by by investing into the land, right? That's effectively. So when you mentioned that you were the mortgage, so basically you lended against the mortgage, right? So you became the first lien holder
Mhm.
on that uh on that acreage, correct? Is that how you kind of protect interest?
Right.
That
So
makes sense.
in addition to the mortgaged, property, we hold about I think we're at about 15% like equity of the company. So there's two different returns there. Whenever there's an exit, there's the sale of the property, which returns the interest on the loan, and then there's the equity exit of the value of the company. We do have a private credit portfolio where we're invested, we're lending to private companies, and that might be inventory financing, PO financing. Maybe they're buying some equipment. We do various types of lending, and they're typically attached to assets. Now, if we're doing inventory financing or PO financing, it's very similar to hard money, except for it's not attached to a piece of real estate. It's attached to inventory, which may or may not have the same value whenever maybe they go into default, right? So there are things like in the alternative space, you're taking more risk naturally, but the return potential is much greater than that if you were going in traditional assets.
Yeah, which really kind of brings us a little bit more is just really about having a different bucket in your investment strategy to go after those things, and you can really determine what's the level of risk you can tolerate for that size of capital and how to best deploy it. So typically, when you're working with your investors in things around the PE, you're kind of pushing them more towards they to invest with their retirement plans in PE because a lot of the returns comes in, one big lump sum and it's not as tax efficient. How do you kind of, mitigate a little bit more about, do you invest from your cash or do you invest from your retirement or you invest from your defined benefit plan? What would be
It
some of the
depends. It depends on the goals of the investor. So in traditional private equity funds or venture funds, you're going to see no return for 5 to 7 years at a minimum, right? And then at the end, there might be an exit. You'll see a big lump sum return. I saw that from the inside and didn't really make any sense of why we couldn't diversify into things that actually provided some sort of dividend payment to investors during our holding period, which is why we blend real assets in with our equity assets into our funds. So we target a lot of tax advantages up front. This is a realized return from your tax savings. Um, in the first couple years, then we focus on cash flowing. So we're investing in either debt or equity in which we can take profit or interest out of our holdings, which then gets paid out to investors in dividends while we wait around for these larger equity exits. There aren't enough. I don't know of other funds that do this. This is how we structure our funds. But for investors, it really depends on age, risk tolerance, timing, all these different things. So, because we have the high growth potential, if you have the capital sitting in a tax advantaged account like an IRA, um, then that is something you want to do if you don't plan on really using any of that money for the next 5 to 10 years and you're 10 years, 20 years out from retirement. It's a great use to use that. We're talking about how can you how can you have the highest growth in the most tax efficient vehicle? I love Roths. I love Roth conversions. So, people that are able to handle that Roth conversion, paying the taxes on converting that capital, that's that a Roth is really, really good for private equity and venture type investing because you're talking about that 3, 5, 10, 100x return that's sitting in a tax-free investment vehicle. For cash investors, it's really about pulling those active tax incentives out using your cash investment. So for our first funds, we were heavily invested in oil and gas, which provides a really significant tax incentive. It's 100% deductible in the year that you make your investment, and about 80% of that investment that goes into oil is qualifies for that tax deduction that first year. For somebody who's really high income or having a large capital gain, like that was super beneficial for them to invest using cash because they got to take that incentive to directly offset their income for the year. Now, we have two other funds. The new fund that we have open now, we're focusing on tax credits. So we've been able to acquire a bunch of tax credits on one of our investments that pass through to investors dollar for dollar. So if an investor, again, has a large tax liability for 2024, 2025, we're able to significantly reduce that tax liability because of the investments we've made. And that gets passed through to the cash investors. So that would be more motivational for a cash investor to use cash if they had a large tax liability for the next 2 years. Other than that, it really just depends on whether they want the liquidity or they don't want the liquidity of it being inside or outside of a retirement account.
I see. So you would look more as a lending as a liquidity, because since it have continuous cash flow streams,
Right.
versus more of a true traditional PE or a VC. It's more of a very back-end loaded, a capital appreciation type strategy. So one you can think about it, one is like a stock, one is a bond in
Yeah.
some sense, in a
Yeah.
slightly different.
We blend the portfolio so you have 25% in credit, 25% in equity, and 25% in real assets, and 25% in venture or something. So it's so that people can see how the alternative space works in general. Because the whole reason why I built this was to give people like a very safe, controlled environment to invest in alts while they learn, what they like and don't like about the space so that they can go make individual investments themselves. This is just an opportunity to passively invest in alternatives in a managed fund. There aren't actively managed private equity funds available for most people under $1 million like investment amounts. So like our minimums are 250. We used to have $100,000 minimums, but found that a lot of people were putting much more towards this strategy. And it kind of going back to your risk tolerance statement, investors like take a Yale endowment, for example, it's $40 billion. That's a lot of money. The Yale endowment can do generally whatever it wants and take as much risk as it wants. And it's not really going to affect their overall return because they're dealing with $40 billion. They're like 90% invested in private equity. They invented the strategy. So when you have a lot of money, you can take a lot more risk than somebody who might have a $3 or $5 million net worth, where investing $2 million of their $3 million into alternatives might not be a good idea. But investing
Right.
200,000, yes, was probably a good idea. I think that people should be comfortable with somewhere between 10 and 25% of their net worth invested in traditional, like alternative assets. I don't really consider real estate to be part of that alternatives allocation. It's kind of its own animal. Like true alternatives, private equity, venture, cryptocurrency, fine wines, collectibles, precious metals, commodities, whatever, all of that,
Agriculture.
yeah, can all be, somewhere between 10 and 25%. If you're younger, obviously you can take more risk and you're in it for longer. So, 30, 40%. I'm crazy and I really understand the space. So again, I'm like almost exclusively in alternatives. So I have a very small stock portfolio. I'm all in private investments.
Wow. Yeah, no, I tend to be more on the other side historically when I worked in tech and I had RSUs and my
Mhm.
401ks. And as I transitioned out of technology in 2019, I understood real estate and have done well for me. So I've shifted very, fast into real estate all the way, kept very little in stock. And now I'm kind of taking a little bit out of real estate slowly, and moving into other things. So we've done debt, probably have done oil and gas and slowly kind of building up my knowledge and my comfort zone to get into more and more PE related things. So for investors that are not seasoned to go pick these investments or don't have the large checks, the
Mhm.
value of looking into alternative wealth partners is, you maybe want to dive into a little bit more about that, is like you guys have a lower minimum of to kind of entry to play into a lot of those PE related space. Maybe do you mind maybe just giving a high
Yeah.
level? Yeah, please go ahead.
So most institutional or family office deal sizes are going to be, tens of millions, if not hundreds of millions of dollars. Um, and the minimum to get involved in those are $2 to $5 million. And that's on the small side. So most family offices are writing check sizes that are a minimum of $25 million. So they're not even looking at projects that are sub $200 million sizes. We kind of scale that back where I have access to those same kind of family offices projects. They're writing a 25 or $50 million check. I can come in on their $50 million check with $1 million or $2 million. And then I get to break that down where an individual investor can write, invest with me for 250 and have access to that $100 million deal. We've been able to do that, successfully over the last 4.5 years. I have a very large network of family offices and institutional partners that allow me that access, right? It's all about who you know in this space, unfortunately. And a lot of that has been gate kept, so it only stays in the family. And because I came from that and broke out of that, you know, I want more people involved in that space, which is why I opened up my funds to retail investors. Um, I'll give you an example of one of the projects that we did in our first fund. We wanted to invest in an oil and gas project, and a lot of the operators in this oil and gas project are publicly traded. So this total size of this acquisition was $100 million. Myself and 3 other partners took out 17 million of it, and we only had to bring in about 4.5 million of our personal equity, like our fund and everything together. And then we were able to leverage the rest of that. The income from the oil and gas assets actually paid down our purchase price in half by the time we actually got to closing. So the revenue from the wells that had turned on actually just did 17 and a half or $7.5 million in income before we even went to the closing table, which was really nice. But those are kinds of opportunities that will never see the light of day. Like that is very much like somebody called somebody at a publicly traded company and said, we want to buy the assets. So, we have that kind of relationship that we've been able to leverage and get access to those deals.
No, that's phenomenal. I totally agree with you. In this industry, it's really about the network and the reach, and that's really the value of people kind of knowing you and being part of your fund because they pretty much automatically get access to all the deals that you have visibility. And we've seen that more in the real estate space, for sure. And in a similar kind of structure, likewise, seems like you're really opening it up for other investors to get into the PE space. What would be the type of projects in PE, like a traditional PE they would look into? And the reason I mentioned that because a lot of investors would not know PE, private equity. And I
Mhm.
keep telling them, hey, there's public stock, you can buy a share of Apple, but you can also buy a private share of this private
Yes.
company. Maybe for those, listeners that are less seasoned about PE, maybe we give them like one or two different examples, based on your experience on what is really PE investing look like.
Sure. So like one of the big news that came out, like I don't know if you guys pay attention to the private equity space, but Jersey Mike just sold to private equity, right? For $8 billion. And that was a
Right.
franchise company that built out a bunch of locations and, ultimately had enough under their franchise arm that they created enough value for a private equity firm to come in and write an $8 billion check. Now, was that all cash? Probably not. But they did come to the table. That founder got, let's say, $1 billion. And now that founder gets to go spend $1 billion on a new venture, right? The one thing about entrepreneurs is when they do exit, they don't stop. So they want to create something else. And private equity waits around so private equity includes venture capital. Private equity is venture capital, growth capital, and leverage buyout capital. So, depending on what the investor appetite is, you can participate at any level of a business. But it could be as early as somebody like an idea on a napkin, like I want to create a cyber security company. And then, maybe over 5 years, they've grown, they've brought in a bunch of staff, they're managing accounts for like Microsoft and IBM or whatever. And at this point, they need $10 million to like get more cloud space, hire more people, sell more stuff. And that's when a private equity company would start getting more interested, right? And this is whenever they get past that growth stage, then you have private equity and corporations competing for the same type of thing. That cybersecurity company could IPO, go public, right? And that's what a private equity company would want. Or someone like Microsoft would say, we actually really like this. We're going to just acquire you. And that's where we're participating all in that middle section. These are all the transactions, the M&A space, the mergers and acquisition space that private investors will never understand or get access to or involved in the deal. Like there's never really an opportunity for an individual to come in and be like, hey, I actually want to buy a piece of Jersey Mike before it sells, right? but that's what we do. Like active asset managers, like go and find these deals, negotiate opportunities, and invest in that middle space. So before you hear about it in the news or before it goes public, like that's where we're investing. And for investors, they just have to decide, like, again, is this something I want to go and work on every single day? Or do I want to partner with a manager who is working on it every single day so that I can continue to do whatever it is that I do, run my business, go to my job, sit on the beach, whatever their goals are. Um, there's a lot of managers out there that have very specific strategies and the spaces that they like to operate in. And those are the deals that you're going to get access to.
Wonderful. Now, typically in real estate on here, I'm trying to do a bit of a contrast.
Sure.
When we're looking at a syndicated property, big part of the weight that we put on the decision is really the sponsor, right? The GP, the general partner. So in this case, how does it look differently when you're trying to vet a specific PE deal?
It's very similar. Like you're looking at the management team, right? You're looking at the people that are running the company, coming up with the ideas and running the everyday, piece of the business. Very rarely do we come in and do majority uh investments where we come in and become the operating team. We do have one asset that we actively manage, and it's a manufacturing company. So I'm not running a manufacturing company every day. Like I'm not going to the factory and like running a factory. I have an entire team, executive team that does that. I have a CEO, CFO, COO. Like I have an entire executive team and staff that runs the daily operations. I just happen to own a majority of the business. So while I'm a strategic partner and I sit on the board, like there are things that I'm doing for the overall strategy of the business and the growth and maybe the exit plan. But as far as running the business every day, I have people that do that. And so that's either people that we're picking out of the ether to do that specifically about their skill set, or we're looking at companies and saying, actually, the existing management team is who we want in place. We believe in them to continue to grow their business. We want to give them the capital and support to do that sustainably. We're looking at the same type of thing that a real estate syndication might also. Is the person that you're investing in the right person to develop the property, or are they just a middleman between the people that are really creating value? And how can you go around that to actually get to the people that are going to generate the return?
Absolutely. Wow, that's actually a great description. You mentioned the different aspects of PE investing between levered, venture, and buyout. Is it okay maybe to double click on that and maybe explain what each one of those section are for
Sure.
the average investors that might have not heard these terms
Yeah.
previously?
Venture has gotten a lot of like publicity. It's like sexy and new, like venture investing. There's all these venture firms out there. Everyone like knows Sequoia and like A16Z and like doesn't really understand what exactly they're doing. Angel investing is like you go in really early with maybe a smaller check. You might be in a friends and family round, but it all falls under private equity, like which is exactly what it says. It's private capital buying equity in companies, whereas
Right,
stocks are public equities. It's publicly
right.
traded equities and companies. So I think that they've tried to like separate themselves, venture from private equity, but it's really all the same. It just depends on at what level are you coming into a business. Are you coming into a business when it's just an idea that needs a lot of capital, a lot of hand holding? There's going to be a lot of time, effort, and money invested in that business before you're going to see any type of return. Growth is where they've achieved some sort of success, whether they've generated revenue, they've found out who their clients are, they're in growth mode. So maybe they could be turning a profit, maybe they're breaking even. This is a really good opportunity. Banks typically get involved at this point, so you are competing a little bit with banks. But a lot of companies aren't bankable necessarily, where their type of revenue banks don't really understand. Maybe it's in an industry that banks don't really like to lend in. Like I'm in defense. So like some of our defense assets, like we had to spend a really long time finding the right bank partner because a lot of banks don't deal with certain types of defense products. So it still needs to be banked, but at the end of the day, some banks do it, some banks don't. This was a big problem with cannabis in like 2015 when cannabis investing
Sure.
was really popular. Not a lot of banks banked cannabis companies, and like even investors today that want to get into cannabis or CBD or, mushrooms and all these other whatever they're getting invested in. Like there's a lot of weird nuances and regulatory things around that. So you just have to depend on, are you at a growth space where you want to see a company go from, they've already gotten to point A, maybe they're at point B and now need to like really accelerate sales. That's when you can come in as either a traditional private lender, or you can come in as equity. You're going to pay more for equity at the growth and buyout stage than you would at the venture stage. But you also reduce a lot of risk because the company is further along. Private equity typically comes in like traditional, with the way that people think about traditional private equity. When they come in, they're typically going to be removing management, replacing it with their own people, and taking it to the next level without the original founder in most cases. We don't typically do that. I like to see generational businesses be built. I want to see that founder stay in place. I want that founder to, ultimately take the company away from us. Like we're invested in this very middle space. I don't really want to take a company away, and I am okay with taking a lower return to see that company flourish without us. Um, it's just our prerogative, and for investors, they just have to decide how long they're willing to stick through a company or not.
Wow, wonderful. So in the middle space, the type of transactions are roughly in the 50 million, 100 million. Where do they sit when you say the middle space?
So
It's
we're invested in companies that range from doing a few $1 million to doing 10 to $15 million. I know that the mid-size companies are much larger than that. There's a lot of small businesses in the United States. Like if people need to think about the size of the private opportunities, the public the public market's trading what, like 6,000 companies in total, when there's
mhm.
millions of privately held businesses, and you can get really granular of that. Like literally in your neighborhood, you can invest in businesses and opportunities and real estate and things that you want to see grow. And this is what family offices are really intentional about too, especially when it comes to like their charitable giving, is that they're really focused on like very regional type things, and they can direct their capital that way. I want to see small businesses grow and sustain over generations. So that's where the capital that we invest goes.
Wonderful. I want to maybe touch on a previous thing that we mentioned, which is around private credit. I know in the real estate side of things, we've been very bullish this year and have done investments in asset-based lending, first lien position and second lien position, and right now because of interest rates are higher and bank are not lending as much, it's definitely a great opportunity on the real estate side to be on the lending side rather than the equity side. And we've seen like returns in the 10 to 12% for like a first lien, again 13 plus for if you go second lien or something a little bit more exotic. Do you mind maybe talking a little bit more about lending side on the PE, and how does that work? Maybe how does that look like, and then what are the typical kind of returns in terms of just a range bucket to give basically the listeners a bit of a, hey, yeah, you can invest into first lien position in real estate, but if you're looking for a little bit higher return, you might want to consider
Yeah,
somewhere over here.
lending to businesses, you're going to see a much higher return when it comes to like PO financing and inventory financing. You could see 15% plus returns. And depending on how many times you're turning that, you could see a pretty substantial annualized return. Because they're typically deal by deal. So on PO financing, you might charge a flat rate for that one PO. And if that PO gets turned every 90 days, then like a purchase order, like turned every 90 days, then you're making that, 10, 12% every 90 days. Um, so you can get a little aggressive in that space. For growth capital, maybe you're paying for a marketing strategy. Maybe you're paying for, equipment to come in. Or you can be on the distressed asset side. You could even finance bankruptcy. So, bankruptcy financing, like debtor financing, you're looking at 18%. Like, and of course it's very risky, but at the end of the day, you could end up with all of your company's assets. And then you could, I mean, that's how I ended up with my manufacturing company. I was originally a lender and now I own a manufacturing company. So, and all of its assets. So it's not necessarily a bad thing to have something not work out. I think, for some people that do promissory notes or, buy bank notes on properties, like the worst case scenario is that you have to foreclose, which is terrible, but you also end up with a property. You can do
Right.
that in the businesses too. You might want to focus if you're doing distressed assets anyways, make sure that you're buying businesses that you wouldn't be mad about having to run at the end of the day. Um, it could be a fun adventure. It could be a fun adventure.
Sure.
Just be prepared that you're either going to have to put the staff in place to continue running the businesses or sell the assets.
Yeah. No, it's almost like buying distressed notes in real estate, right? Where,
Yeah, it's the same. Like if people think about it the same way, it's the same
right.
opportunity. Your asset is just an operating business and not a piece of property.
Wow. That's great. And typically you look at investment in these areas as well to try to get the cash flow component
Yeah.
balance of the fund or
Yes.
wonderful. All right. Well, I think for the last part, would love to learn a little bit more about just the background, not a pitch of the fund, but like what is really the fund? Why would an investor want to consider your fund? And then finally, what's the best way to get in touch with you and learn
Sure.
more?
So I believe that we're headed into the next industrial revolution. So there's been a lot of investment and a lot of innovation in technology, but not necessarily the infrastructure around it. And when I talk about infrastructure, I don't mean like roads and bridges. It's more about broken systems. So like the energy grid, the data storage issues, like true infrastructure, like broken systems. And manufacturing. I think that we're going to be bringing a lot of things back domestically. How do we innovate in that space? And for me, having understand that the energy space pretty significantly is that, we're only going to be able to achieve these goals if we can bring down the cost of energy. And that comes through energy efficiency, that comes from the energy transition from fossil fuels to renewables. And, while we don't invest heavily in renewables, we do invest in the systems that are built on those. So, like storage and oil and gas, the cheapest place to store oil and gas is in the ground. If you know it's there, just leave it in the rock. It's free. But for everything else, we have to create systems around how to store that power and then use it efficiently. So, I've spent my, in my entire career in sales operations and in the family office space. And so, this third fund that we have open is called the AWP Diversity Fund 2. We're raising $150 million. We're invested in the energy infrastructure manufacturing space. Some of that includes real estate and traditional private equity opportunities. The minimum is $250,000. You can use cash qualified funds. You can even use DAF, which are donor advised funds. So you can do a charitable contribution into the alternative space. You can find us on alternativewealthpartners.com. I'm very active on LinkedIn. So if you just want to know more about like what I'm thinking and the things that I talk about or am looking at, I engage a lot on LinkedIn. It's a great place to start to get to know me and my team. And then when you're comfortable, you can always reach out and we can have a conversation face to face.
Wonderful, Kelly. Well, definitely appreciate your time getting so much knowledge and sharing with the audience here today. And hopefully a lot will find this value and follow you and try to invest in your fund down the line. We wanted to thank you on behalf of Bluestone Flagship Investor for joining our webinar today. And we look forward, having you on future session as well.
Thank you for having me.
Thank you.